Hi, everyone. This is Carly Smith. I'm one of the investment advisors at ML&R Wealth Management. Thank you so much for taking the time to listen in today as we provide our latest market update. It certainly has been an interesting time for the world with all that's happening with the coronavirus. Our lives are being impacted in so many different ways. It's been challenging for everyone to adapt to this new temporary normal, both at home and with work. There's so much anxiety and uncertainty swirling around, not only for our personal lives, but also with our investment accounts. While we're trying to keep our families safe and our work relatively uninterrupted, we're also having to deal with the reality of what comes with a 30% drop in the stock market with no real clear ending in sight. For many, it feels like uncharted waters. For others, you may be grappling with the feeling that it just feels different this time. Regardless of how you're feeling, the emotional pull and the very personal connection we all have to our money is very real and very raw during times like these. And regardless of your investment experience, when we have the level of market volatility that we've experienced over the last month or so, the same questions tend to come our way from our clients. Hopefully, by spending the next several minutes or so answering these questions, you can gain some sense of peace and begin to feel less anxious about your investments so that you can focus on what really matters most to you, which is your family and work. What are these questions? What should I be doing with my current allocation? Meaning, should I reduce my stock exposure? Is it different this time? And is now a good time to purchase more stocks? Addressing the question of should you reduce your stock exposure, in order to understand this well, it's important to understand the emotional human nature of investing. When we are in challenging times, facing rapidly evolving information, the market naturally becomes more volatile. Many investors struggle to separate their emotions from what is happening in their investment accounts. When the market is good, investors tend to be more optimistic and more willing to put money in. On the other hand, when markets are bad, investors become fearful or even in some cases panicked, which can result in poor decisions at the absolute worst times. Because we are in a downturn, it has many wondering if they should reduce their overall stock exposure in their investment accounts. This desire is primarily being driven by the anxiety and stress produced by the current volatility. Try to remember that this is what was planned for when you determined your risk tolerance and set the initial portfolio allocation. It's easy to think about the upside potential. It's much harder to be on the opposite end of that. No matter what the stock allocation is set at, if the portfolio is properly diversified, it is built to withstand this volatility in the long run. To put this all into perspective, if you think about the safest time to get off of a roller coaster, it certainly isn't while you're on the ride. The same is true for your investments. Making a change to your allocation must be a permanent decision, in our opinion. Making the adjustment today and then reevaluating in 3 months is a risky chance to take. Essentially, at that point, it would become market timing. And the problem with market timing is that you really have to be right twice. You have to be right when you sell, and you have to be right when you get back in. The research overwhelmingly shows that this is a near impossible thing to do. If you're investing for the long term, then the best thing to do is to stay the course. Once markets stabilize and once you've had the opportunity to reflect back on what you just experienced, if you still think that that was too much to bear, then at that point, it would be a much better time to reduce your overall stock allocation. It isn't while we are in a downturn. Many investors are wondering if this financial crisis is different than any in the past. The answer is yes, it is different, but only because the world is dynamic and is always changing, which means with each downturn we experience, it will be different than the last. What is constant is that the market is working exactly as we would expect given the uncertainty in the world. Each day when new information comes out, the market adjusts to that information. And we've seen this a lot in the last few weeks. There will be good news related to the coronavirus, and we have a great day in the market. The next day, it'll be bad news, and it's a bad day in the market. But if we review the last 7 financial downturns, We see similarities between all of them as it relates to the recovery. Each downturn has its own reason for occurring, each has its own length of time to last, and each has its own recovery time. However, what's most important to point out is that there was a positive subsequent return 1 year after each bottom in all but 2. In all 7, there was a positive subsequent return after 3 and 5 years. Although a global investment strategy with 60% allocated towards stocks and 40% allocated towards bonds suffered losses immediately following the specific events that caused the financial crisis, the financial markets recovered relatively quickly. The important takeaway is that if you are in it for the long run, all that is going on right now is just noise. You don't need the money right now, so try to put it out of sight and out of mind. An additional data point that might help put the emotions we are feeling in perspective is talking about the actual volatility that has occurred throughout the years, even when markets are producing positive returns on average. This chart shows the entire calendar year return for each year, along with the largest gain and decline for that year going back to 1979. The blue bar is the calendar year return, and the whiskers, or the black and red line, show the range of gains and declines throughout that same year. So for example, if we look at 2009, the market had a calendar year return of about 28%. However, the largest decline during that year was close to 30%, while the largest gain was almost 73%. So while there's a lot of variability throughout the year, at the end of the day and at the end of the year, there was still a positive return. If we were to break this out by decade, and thinking back to our question on whether this time it's different, we can actually answer it by reviewing the levels of volatility, since volatility can be quantified. The higher the number, the more volatile it is. And if we think back for each decade, going back to the 1970s, and we list the measure of volatility for each, what we find is that each decade has its own major event, which brings high levels of volatility. What is most interesting is that the last decade actually had less volatility than prior decades. Perhaps the reason it feels so painful right now is that we have gotten very comfortable with the upward trend of the market over the last 10 years. The important takeaway is that what we are experiencing now is definitely not an outlier. Whenever there's a downturn in the market, one of the more common questions we get is whether it makes sense to buy more stocks. Based on historical return data, we would say that any time is a good time to invest. In general, as an investor, individuals invest to get a positive return, otherwise you wouldn't do it. The investor receives this return because they are willing to take on risk. Otherwise, you would just purchase T-bills at the risk-free rate. The interesting outcome, no matter when you purchase, based on the historical return data, the average subsequent return is positive. Even when the market is at an all-time high, the average subsequent return is still positive. So rather than trying to time the bottom or stress out on when the right time to buy more stocks is, know that on average, the return data is in your favor. We think it's very normal and natural to experience stress and anxiety during a financial crisis. But if you stay disciplined and true to your investment strategy, it will pay off in the long run. As always, we are here for you. If you have any questions or concerns, please feel free to reach out to us.